Hey everyone, in this video, I'm bringing you one growth stock that's down 96% off its high that I think you can buy now. Yes, that's right, down 96% off its high, and I think you can buy it now. So in addition to telling you what this growth stock is, I'm going to explain to you why I like this stock and why the stock got in trouble and why it's down so much to begin with. So I'll go through all of that so you get more information on why I'm recommending this growth stock. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the growth stock that I'm talking about in this video is Peloton. Peloton is still down over 95% off its high, 96% off its high, despite the fact that in the last 2 days, the stock price is rising given the announcement of this deal with TikTok. And with over 1 billion active TikTok users globally, this deal has the potential to really boost sales for Peloton, and sales is really the problem that Peloton is having. So let's go through Peloton and see what's happening at the business. So what I have here is Peloton's latest quarterly statement. This is for the period ended September 30th. And you could think of Peloton's business in two segments. Number one is sales of the hardware, the bikes, the treadmills, the physical equipment that it sells to you, the exerciser. The other part of the business is the subscription that comes with the sale of the physical hardware. And that is the access to the live classes, the recorded classes. That part of the business is very lucrative. The part of the business that has been struggling is the hardware. So let me demonstrate that to you. In the latest quarter, if you look at 3 months ended September 30th, let's first look at 2022. You could see the connected fitness products brought in revenue of 204 million, but the cost of revenue connected fitness products were 259.8 million. So it lost 55 million selling that physical equipment. That's where the struggles came from. During the pandemic, the business absolutely boomed and management couldn't keep up with customer orders. Customers were waiting as much as 10 weeks to receive their Peloton products. So what did management do? They said, well, let's expand. Let's increase manufacturing capacity. Let's purchase a manufacturing company and let's build our own manufacturing capacity and really double down and expand because, as management said at that time, we're playing chess while others are playing checkers. Turns out when gyms reopened, their sales collapsed, and all of that investment in manufacturing turned out to be a huge misstep and added too much fixed cost to their structure. And when sales fell, they weren't able to decrease cost early enough. So there was a management change. Now this new CEO came in and has started to shrink manufacturing and any kind of in-house manufacturing, go back to outsourcing manufacturing and really bring down costs to right size the business to where customer demand is, right? Just right size it. That's what I thought this business needed. And that's all I think this business needs, is to just get smaller, right? It's not for everyone. In-home exercise equipment is not for everyone. It's not for every single person that exercises, right? That's what previous management thought. They thought everyone who exercises, that's our market opportunity. We can reach all of those people. No, there's only a certain subset of the people that exercise that prefer to exercise at home. For instance, myself, I like to go to the gym because the gym has a basketball court and I want to play basketball, right? I exercise, but I'm not a potential customer for a Peloton product. I'm not going to buy a Peloton product. And so there's that subset of market. Think of people that like to go to the gym just to swim. A lot of gyms have pools, so people go to the gym to swim. Those are not customers, or those are less likely to be customers of Peloton. And so you get the point. The previous management team was shooting a too broad of a target in terms of accessing the market. I think they need to shrink. They need to be more focused and really go after that core business, that core Peloton enthusiast. And there's millions of those. There's millions of those. As you can see here, you can look at their subscription revenue. That business is strong. Now let's jump to 2023, the most recent quarter, 415 million in subscription revenue, and the cost of subscription revenue is only 135 million. Look at that big gap between the subscription revenue and the cost of subscription revenue. That's the lucrative business. That's what Peloton needs to do, is just manage a small profit on the hardware sales, right? Like they did in the most recent quarter. 180 million in connected fitness product sales, and the cost were 175 million. That's fine. That's fine. Small profit margin on that segment is fine because you get those customers into your ecosystem. You get them to sign up for the subscription, which most customers that buy the product do sign up for the subscription. That's where you get them to generate profit for the company. So generate a small profit on the hardware sale or break even. That's okay. And then where you get them, where you profit from, is to sell them that subscription. And that's where the new management team has been focused on. And you can see they've made progress, and the company has done a good job expanding gross profit from 217 million to 285 million. And this is one of the reasons why now I feel comfortable recommending Peloton stock, is because I feel the new CEO and the new management team has done a good job in turning things around and moving it in the right direction, where I can feel confident that they're going to stay in this direction. Even though their work is not done, the company is still losing a lot of money on the bottom line. It still needs to untangle itself from some of the decisions made by the previous management team. But I've seen enough evidence of the company moving in the right direction to feel good about recommending the stock. And you can see here, you can see that big boom during the pandemic when sales exploded, and then sales collapsing as economies reopened and the gyms reopened. People returned to gyms. The interesting thing was that even before the pandemic, Peloton was increasing sales by 100% every year, even before the outbreak. So you can understand why management was so confident when during the pandemic, sales increased by even more than 100%. Sales nearly tripled, that they felt like, okay, it's a good time to increase capacity, because they were looking at their history and the growth even before the outbreak and thinking that there's a big market ahead and for them to go ahead and invest to increase capacity. Maybe there is, but it's just not as much as thought, right? The people that wanted Peloton products probably all bought them during the pandemic, and as gyms reopened, the incremental customer, there was very few incrementally new customers, because most of the customers that wanted a Peloton product that were on the fence probably bought it during the pandemic. And so you had this big revenue collapse, but it looks like it's stabilized, 2.8 billion in the most recent trailing 12-month period. And you can see company getting the costs under control. Operating income collapsed as economies reopened and gyms reopened, but the new management team turned things around, and you can see a consistent moving in the right direction. I wouldn't feel comfortable recommending it here when it barely turned around, but now we've got some time where it's been moving in the right direction, and I can feel comfortable in seeing the steps that they've taken, that it's going to continue moving in the right direction under this new leadership team. And similar story with cash flow from operations. You can see the collapse and then the rebound, and you can see it moving in the right direction. And given the steps that they've taken, I can understand and I can be reasonably confident that it'll continue moving in the right direction. Inventories were a problem because, like I mentioned, the previous management team invested so much in increasing capacity that they just built up so much inventory. There was not enough customer demand for it. So inventory exploded all the way up near $1.4 billion worth. But you can see the new management team came in and said, all right, we've got too much inventory. we're not going to build. We're just going to shut down our manufacturing, sell whatever we can sell, and just work through our existing inventory. Just sell whatever we have on hand. And that's been great for the company because that's inventory that was sitting around. Now it's turning into cash, which the company needs. And it needed desperately. It's not in such desperate shape now, but it was in desperate shape around this time when inventory was soaring and cash flow was shrinking. The balance sheet has been damaged as a result of those decisions, but new management is improving, and you could see that they have not had to take out any more new debt for about over a year now. So they had to borrow a bunch of money because they were losing so much after the decisions of the previous management team. But it's been stable, 1.688 billion for over a year now. And given that they're not losing that much cash flow right now, and they've got inventory and they've sold and they're selling some of their manufacturing and shrinking their size and capacity and employee base, I don't think they're going to need to borrow anymore. They don't need to, and they still have 748 million in cash and short-term investment on hand. They've got a long runway, and given the speed at which they've improved things, I don't suspect them to need to borrow. I think they're in a stable financial position now. Not a great position, I will point out, just stable, and that's an improvement from the desperate position they were in about a year ago. And finally, the stock is still incredibly, relatively cheap. If you look at its forward price to sales ratio of 0.843, you've never been able to buy Peloton stock at a cheaper valuation. Now, given it's still got room to go to improve its position to return to a positive profitability, positive cash flow from operations, but I think I can see that happening given the steps they've taken. And at this valuation, I think it's a good time to step in slowly and add some Peloton shares if you're looking for a growth stock to add to your portfolio. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.